So, you know exactly how a ruler works, right?
Yeah, I mean, you measure a piece of wood, it's 12 inches.
Right, exactly. It is exactly 12 inches long. It is an undeniable, objective fact.
Because the wood represents reality, you know? The ruler just, it just reports it to you.
But I want you to imagine a completely different scenario. Imagine you measure your house.
Okay.
It is 2,000 square feet. Then somebody sneaks in at night. They swab out your tape measure.
Mm-hmm.
You wake up. You measure the house again. Suddenly, it's 4,000 square feet.
And you didn't, like, lay a single brick.
Nothing. You didn't pour any concrete. You touched absolutely nothing.
Wow.
But you march down to the bank anyway. You show them this new number, and the bank instantly loans you twice as much money.
I mean, that sounds completely absurd. It sounds like a cheap parlor trick.
Or outright fraud.
Right. Totally illegal.
It does. But it actually happened. Welcome to a brand new deep dive. We are looking at a landmark 2007 study today.
Yeah, authored by Mingyi Hung and K. Subramanyam from the University of Southern California.
And our mission today is massive. We are going to uncover the invisible strings that actually control the world's wealth.
And we mean that literally. We are talking about changing a few really boring paragraphs in a dry, bureaucratic rule book.
Just a rule book.
Yeah. And those specific changes created trillions of dollars out of thin air.
Trillions.
Yeah.
With a T.
Literally.
I mean, it sounds illegal. It sounds like a cinematic heist movie. But it's actually just accounting.
Just accounting. Let's set the stage for you. The year is 2005.
Okay.
The European Union forces this massive continent-wide change. They demand that companies abandon their local rules.
And switch to what?
They had to switch to international accounting standards. We call it IAS.
IAS. Got it. And we're looking specifically at the German companies that piloted this switch, right?
Exactly, the pilot group. And this was not like a routine software update. It wasn't a simple paperwork exercise. It was a total fundamental rewrite of reality.
A single sheet of paper rewrote the wealth of nations overnight.
It did.
We have to ask a crucial question here. How did invisible rules suddenly inflate global assets on a massive scale?
Well, let's unpack this, because here is a viewpoint that is going to completely subvert everything you know about business.
Okay, lay it on me.
Most people think physical factories create wealth.
Sure. Building physical products creates wealth.
Wrong. The yardstick measuring those things creates the wealth.
That is wild. Think about the fundamental laws of gravity. You know,
Yeah.
If you somehow change the laws of gravity today, everyone on Earth would instantly weigh less on the scale.
Right. Nobody dieted.
Nobody spent hours at the gym. The rules simply changed. That is exactly what happened to global capital here.
Exactly. The European Union pushed IAS to standardize the entire globe. They wanted everyone speaking the exact same financial language.
Like, they wanted American investors to easily read European spreadsheets.
Yes. IAS quietly became the invisible master of global asset valuation.
But wait, hold on. No actual money changed hands, right?
No.
Like, no gold was moved from one vault to another in Zurich.
Not a single euro coin was minted, but the fundamental value of the entire world shifted entirely.
To understand this massive explosion of wealth, we have to travel directly into the eye of the storm.
We have to go to Germany.
Germany. German companies historically treated extreme caution as a religion. Right?
Oh, absolutely. They were notoriously stubbornly conservative.
So why did they suddenly embrace the Wild West of what accountants call fair value?
Because this was not a math problem. Math is objective. 2 + 2 is 4.
Right here.
This was a brutal philosophical war for the actual soul of the financial continent.
A philosophical war. I like that.
Yeah.
We are looking closely at data from 80 pilot German companies, right?
Yeah, 80 companies. And this data covers the transitional years between 1998 and 2002.
Okay.
I want you to imagine 2 heavyweight gladiators stepping into an arena.
Let's do it. On one side, you have the old German rules. They call it HGB.
Right. HGB was built specifically to protect stakeholders. Think about creditors.
Banks.
Banks, everyday employees. It was deeply pessimistic.
Pessimistic. Highly secretive.
Yes. It was entirely about hoarding cash for rainy days so the company would never, ever go bankrupt.
Okay, so that's gladiator number one. On the other side of the arena, you have the new international rules. IAS.
IAS was built entirely for shareholders, the investors.
Day traders.
Day traders, yeah. It was fiercely optimistic. It was flashy.
Flashy.
It demanded that you show off every single dime of your current present-day value to the general public.
It is exactly like replacing your financial advisor.
How so?
Imagine you fire a paranoid doomsday survivalist who buries your gold in the backyard.
Okay, yeah.
And you replace him with a flashy influencer who demands you leverage everything to lease a sports car.
That is a perfect analogy. And when that influencer took over the corporate books,
The numbers went absolutely crazy.
total chaos. Which brings us to the German asset inflation miracle.
The miracle. 0 new cars were sold, 0 new factories were built, 0 new products were invented.
Right.
Yet total assets suddenly skyrocketed. How is that physically possible?
Well, they didn't build anything. They just changed their language. And paper wealth exploded.
Let's look at the raw data from the study. What actually happened when they flipped the switch?
Okay, under the old pessimistic German rules, the average assets for these companies sat at 3.446 billion euros.
Okay, that is a very healthy number for a major corporation, 3.4 billion.
Now run the exact same companies under the new international rules.
Same exact day.
Same day, the average jumps to 3.936 billion euros.
Wait, hold on, stop. I need to make sure I'm hearing you right.
Yeah.
Nearly $500 million materialized out of thin air per company.
Yes. The exact same companies, the exact same day.
I mean, how does almost 500 million euros just appear?
It's wild, right?
Did the CEO find it buried in the corporate couch cushions? Where does €500 million hide?
It was always there. The old rules just forced them to pretend it wasn't.
Oh, wow.
Yeah, the old rules forced them to write down the value of their stuff to almost nothing.
Just to be safe.
Exactly. The new rules forced them to admit what it was actually worth on the open market.
Right.
But the real shock is what happened to the actual owners of these companies.
The carnival of exploding shareholder equity. I want you to imagine this.
Yeah, put yourself in their shoes.
You log into your banking app tomorrow morning. You blink.
Oh.
You rub your eyes.
Yeah.
Your account balance is magically 42% bigger.
Boom.
That is exactly what these corporate shareholders woke up to.
The underlying physical business was completely identical. The factory workers were the same. The supply chain was the same.
Nothing changed.
Nothing. But the rule rewrite conjured a massive instant pay raise for the owners.
Imagine the pure, unfiltered euphoria of that. You get a 42% bump in your net worth.
And you did absolutely nothing.
You just switched calculators.
Let's look at the specific numbers on this. Equity, under the old rules, was 653 million euros.
Okay.
Under the new rules, it hit 930 million euros. A staggering 42% jump. This was a literal wealth generation carnival on paper.
But there's always a dark side to a sudden economic boom, right?
Oh, always.
You never just get something for nothing in finance. The universe demands a trade-off.
Exactly. You get the curse of volatility.
The curse of volatility.
The richer these companies looked on paper, the more dangerously fragile they became in reality.
Wait, their operational risk literally doubled overnight. Why?
Because of fair value.
But fair value sounds like a wonderful term. It sounds deeply honest and transparent.
I know. But in reality, fair value pushes safe, boring companies straight into the path of violent market hurricanes.
Wait, how did that work? If you just tell the truth about what your stuff is worth, why does that make you fragile?
Because the market changes its mind every single second.
Oh.
Under the old rules, if you owned a building, it was just a building. It sat on the books at a steady, boring price forever.
Right.
Under fair value, if the real estate market crashes on a Tuesday, your company's official wealth crashes on Tuesday.
That makes sense. The data on this from the study is staggering, isn't it? What did the researchers find?
We look at the standard deviation. That is the statistical measure of how wildly the value swings up and down over time.
Right, the volatility.
Under the old rules, it was a calm 1.54 billion.
Smooth sailing, a gentle ride.
Under the new rules, 2.70 billion.
Jeez.
The volatility almost completely doubled. The smoothing effect of the old rules was totally gone.
It is exactly like taking the heavy protective shock absorbers off a massive truck.
Yes.
You lower the suspension to the ground, you make the truck look incredibly cool and fast for the showroom.
Right.
But the moment you try it, you feel every single brutal bump in the road. It shakes your teeth right out of your skull.
Let's put a real recognizable face to this chaos. Let's look at one of the most famous brands in the entire world.
BMW.
BMW.
The digital rebirth of a multi-billion-dollar empire. BMW builds massive, heavy, physical machines, right?
Exactly. They stamp raw metal.
But in the year 2000, their biggest engine was not under the hood of a car. It was a digital rebirth on a spreadsheet.
The old conservative German rules were actively hiding a colossal mountain of wealth from the general public.
Look at BMW's specific numbers from the year 2000. Under the old rules, their stated equity was 4.89 billion euros.
Okay. Then they restated that exact same year under the new international rules.
The same year.
The number jumped to 9.43 billion euros.
I have to pause again. That is a 92.6% increase.
Almost double.
Their total net worth nearly doubled.
Yeah.
And they did not sell a single extra sedan to make that happen.
Not one.
I have to push back here. I really do. How does a legacy car maker double its net worth with a pen stroke? Physically, where did the money come from?
The biggest chunk of that hidden money came from a very specific accounting magic trick.
Okay.
A trick regarding ideas.
The capitalization magic of R&D costs, research and development.
Yeah.
Here's a massive shift in logic. Spent cash used to mean lost cash. If you burned it in the laboratory, it was gone. Suddenly, BMW figured out how to turn money they had already burned into solid gold assets.
Ideas and failed experiments were not just fleeting thoughts anymore. The new rules transformed them into hard, taxable wealth.
Explain the mechanism to me. How does this actually work in practice?
Let's say BMW's engineers spend millions trying to develop a lighter engine block.
Okay.
Under the old rules, that research is strictly an expense. Money goes out the door. It hits the income statement.
It lowers your profit.
Right. It makes it look poorer to the world.
That makes total sense to me. You spent the money, you no longer have the money.
But under the new rules, if management believes that engine block idea might actually work in the future.
Might work?
Yeah, and generate sales, it becomes an asset. It does not hit the income statement as a loss.
Wait, really?
Yes. It goes onto the balance sheet as a permanent piece of value. It makes you look richer.
BMW added a mind-blowing 2.05 billion euros to their equity just by capitalizing R&D.
2 billion, just for ideas.
That is over 40% of their massive jump.
They literally monetize their own internal optimism.
The logic of this is profound. Listen to this.
Okay.
If I spend $1,000 in my home kitchen trying to invent a brand new type of sandwich.
A sandwich?
Yeah. And the sandwich tastes terrible, I am out $1,000. I lost the money. My bank account is smaller.
Right.
But if BMW does it under these new rules, and they simply declare the sandwich has future economic benefit, they just created a new asset, they are magically richer.
It's exactly like that. But it wasn't just invisible ideas making them rich. They also brought old, dying physical machines back from the dead.
Depreciation release.
Yeah.
The undervalued industrial cornerstone.
Yeah.
Imagine massive factory machines.
Right.
They're stamping out doors and engine blocks 24 hours a day.
Right.
On the official German books, their value is listed as 0.
0.
A rule change instantly resurrected them.
Because the old rules let companies pretend their massive machines died extremely fast.
Why would they do that?
To completely dodge taxes.
Explain how pretending your equipment is broken saves you money.
It is called accelerated depreciation.
Okay.
If you tell the government your 50 million euro machine loses all its value in just 3 years, you get to deduct a massive amount of expense from your profit every year.
Lower profit means a lower tax bill. You pay the government less.
Exactly.
So they were legally lying about the lifespan of their factories to hoard cash.
Legally lying, yes. But the new international rules force them to admit the truth.
Which was?
The machines were absolutely fine. They would actually last for 20 years.
The researchers point out that the new international rules banned aggressive depreciation entirely, right?
Banned it. BMW had to switch to normal, straight-line depreciation.
So they had to spread the value out evenly over the real life of the equipment.
The result of just doing that, 669 million euros of value was instantly added back to their books.
Wow. It is the ultimate double standard.
How so?
It is exactly like telling the IRS your vintage car is a totally wrecked, worthless shell. But turning around and telling your insurance company it is in pristine showroom condition. You play both sides.
Exactly. But while they gained massive value in these physical machines, they lost their most powerful secret weapon entirely.
Killing the reserves. The profit buffer totally disappears.
Yes.
The secret corporate piggy banks were completely smashed. Why did the new rules ruthlessly kill the corporate rainy day fund?
Because stashing away cash for a bad year seems like highly responsible behavior to a normal person, right?
It does. It's what we're all taught to do.
But the new international rules labeled it illegal market manipulation.
Wait, Being financially responsible and saving money is now illegal? How?
Because it hides the truth from the investor. German companies absolutely loved what they called secret reserves.
Secret reserve.
Yeah, if they had an amazingly profitable year, they didn't want to show it.
Why not? I mean, every company wants to brag about record profits.
Not in Germany. If you show massive profits, the labor unions demand higher wages. The government demands higher taxes. The shareholders demand massive dividends.
So they hid the extra profits in provisions.
Yes. They artificially created future liabilities. They buried the treasure.
So they look poorer than they actually are.
Right. Then, if a recession hits and they have a terrible year, they quietly dug up the treasure.
They drained the provisions to make the bad year look totally normal.
It is called earnings smoothing.
The new international standards hated this. They killed it immediately.
They demand absolute transparency in the present moment.
They forced BMW to release 673 million euros of hidden reserves straight back into their visible equity.
They force them to show their entire hand to the world. You can't hide a good year. You can't hide a bad year.
It is exactly like stuffing your massive year-end bonus under the mattress so your spouse doesn't spend it all at once.
Yeah.
The new accounting rules walked into the bedroom and literally set the mattress on fire.
And with that protective mattress gone, all their high-risk financial bets were suddenly exposed to the harsh sunlight.
Coming onto the balance sheet, the high-risk game of derivatives.
Yeah, this is huge.
High-stakes financial bets used to live entirely in the shadows, right?
Strictly off the books.
Yep.
Nobody outside the Treasury Department knew they existed.
Now, they hit the balance sheet like a bomb.
Forcing companies to show their hidden gambles created massive instant wealth, but it also placed them directly in the crosshairs of future disaster.
How did the old rules treat these wild derivative bets? Say I buy a contract to hedge against currency fluctuations.
Old rules measured financial instruments at their original historical cost.
Okay.
If you paid 10,000 euros for a derivative, it stayed at 10,000 euros on the books forever, no matter what happened in the market.
That seems disconnected from reality.
It is totally disconnected. The new rules use that magic phrase again.
Fair value.
Fair value. What is that derivative worth right this exact second on the open market?
Right.
For BMW, evaluating these complex financial instruments at fair value resulted in a massive 1.07 billion euro positive adjustment.
Wow. They gained €1 billion just by looking at the current market price.
Yep.
But you have to point out the extreme danger here to the listener. If you mark it up when the market is good, what happens when the market goes bad?
It reverses completely.
If market prices drop tomorrow morning, that $1 billion gain evaporates instantly. Poof, gone.
Direct it.
It hits your equity directly. It is living on a razor's edge. You are tying your company's core value to the whims of day traders.
Speaking of things completely blowing up, let's look at the biggest negative shock of all. It wasn't all just free money and ballooning assets.
The gray rhino descends. The sudden blow of pension liabilities.
Oh, yeah.
Right in the very middle of this massive wealth explosion, an invisible debt crashed down on their heads.
Because accounting didn't just look at the present moment anymore. Under the new international rules, it started actively predicting the distant future.
And the future looked wildly, unsustainably expensive.
We are talking about pensions.
Yes. The retirement promises made to millions of workers. Under the old German rules, companies only recorded the pension obligations they owed right now, based on current present-day salaries.
Which seems totally logical. You owe what you owe based on what people make today.
Exactly.
But the new rules disagreed. They forced companies to calculate future expected salary increases.
They had to guess how much people would make 20 years from now.
Yes. Factor in inflation and record that massive future cost on the balance sheet today.
This was a brutal hit. Across the sample companies in the 2007 study, this new actuarial assumption slashed an average of 77 million euros directly out of their equity.
Just bleeding out on the table.
I mean, imagine being handed a massive legally binding invoice today for a raise you haven't even given your employee yet.
Right.
A raise you might not give them for a decade.
It's maddening. You are prepaying for a future that hasn't happened. This violent tug of war between old and new rules created a totally new beast in the accounting world.
Tax decoupling. The thick fog of deferred taxes.
The most confusing thing...
The taxman and the corporate accountant filed for a messy, highly public divorce. The result. The most confusing, massive number on the entire balance sheet.
Severing the link between tax rules and financial reporting created a phantom realm of money. Money that does not actually exist yet, but haunts the spreadsheets.
Let's break this down clearly. Under the old German system, it was simple. It was called the authoritative principle.
Right.
If you claimed a deduction on your tax return to the government, it had to be on your public books to the shareholders. They were tightly married.
But the new international rules broke that link completely. They wanted the public books to look wildly different from the tax returns.
Why do that?
Because the government wants you to use specific tax rules, but the shareholders want to see the economic reality of fair value.
Okay.
When those two numbers diverge, a gap opens up.
Give me a concrete example of that.
Let's go back to the factory machine. You tell the government the machine died in 3 years to save on taxes.
Right. Accelerated depreciation.
But you tell the shareholders the machine will last 10 years to look highly profitable.
Sneaky.
The government says your profit is 0. The shareholders see a profit of 10 million.
That sounds like you are eventually going to owe the government money when that gap closes.
Exactly. That future obligation is called a deferred tax liability.
Okay.
It impacted 95% of the companies in this study. The standard deviation was a massive 275 million euros.
Good grief.
It was pure, unadulterated chaos trying to reconcile these two parallel universes.
It is like having a parallel dimension.
Yeah.
Over here in the shareholder universe, your wealth is one massive number.
Mm-hmm.
Over there, in the government tax universe, it is entirely different.
Yeah.
And the two universes balance each other out using completely phantom money that hasn't been paid yet.
So with all this absolute chaos happening on the balance sheet, the inflated assets, the disappearing reserves, the deferred taxes, what happened to the ultimate scorecard?
You mean the actual profits?
Yeah. What happened to the profits?
The profit myth. Are higher profits actually real? Everyone assumed the new rules created higher profits across the board.
But that was a paper illusion.
It was a statistical trick masking a deeply disturbing reality.
The average profit went up, but the median profit went down.
The rich got much richer. The typical everyday company got much worse off.
Let's look at the net income. Average profit under the new rules was 165 million euros.
Okay, that is significantly higher than the old 143 million.
But the median profit, the company right in the dead center of the pack, actually dropped.
Wow.
The new rules did not make companies universally better. They just stretched the extremes. They created massive, violent fluctuations that rewarded massive corporations and punished normal ones.
Look, if Elon Musk walks into your local dive bar, the average person in that bar is suddenly a billionaire.
Exactly. Averages lie.
The typical median company actually suffered on paper under these new rules because they didn't have billions in R&D to capitalize.
This brings us directly to the most shocking discovery of the entire 2007 study. This is the moment everything flips upside down.
A completely counterintuitive discovery. The new standard isn't better received.
Think about what we just discussed. The new rules gave investors everything they begged for.
More transparency.
No secret reserves. Higher equity, real-time fair value.
So the stock market must have loved it, right?
Wrong. They hated it. Investors actively distrusted the new, flashy international numbers.
No way.
They fiercely preferred the old, secretive, pessimistic German system.
Wait, the researchers tested this mathematically. They didn't just guess.
They looked at how well the accounting numbers actually explained real, breathing stock prices in the market. This is called value relevance.
Under the old German rules, the numbers had an 84.1% explanatory power. They tracked reality beautifully.
Very closely.
When the accounting profit went up, the stock price generally went up in a predictable way.
And the new, highly transparent international rules.
They dropped to 79.6%. The new standards correlation with the real stock market actually went down.
Why? I want you to think about this critically. Why would highly sophisticated investors aggressively reject more information?
Yeah, it doesn't make intuitive sense.
Why would they prefer a system that actively hides things in secret corporate reserves?
Because that new information wasn't a signal. It was pure, unadulterated noise.
Fatal noise. Did profit adjustments become deadly distractions?
All those massive adjustments to profit, the derivatives swinging wildly, the phantom deferred taxes, the capitalized R&D, they weren't seen as brilliant insights by Wall Street.
Not at all.
The market treated them as highly toxic garbage.
In trying to capture every tiny microscopic market fluctuation every single day, the new accounting rules became completely detached from the core underlying reality of the business.
The study did what they call an incremental test, right?
Yeah, they isolated just the new adjustments that IAS forced companies to make.
And The coefficient for the new profit adjustments was negative 12.00, and it was highly statistically significant.
Let's translate that out of academic speak. In statistics, this means the new adjustments were literally adding measurement error.
They were actively blinding the investors.
They were a massive distraction from the truth of whether the company was actually good at its core business.
Think about your brand new ultra-high-definition television.
Okay.
You buy it. You go into the settings. You want the best picture possible, so you turn the sharpness all the way up to 100.
Because more sharpness is better, right?
You think more detail means a better image. But suddenly, the picture just becomes a blurry, unwatchable mess of jagged pixels.
Yeah.
The halos around everything make it impossible to see the actor's face. You ruin the image by trying to force too much detail onto the screen.
Because the profits were now a blurry, noisy mess of fair value adjustments, investors did something entirely unprecedented.
What did they do?
They completely changed how they valued companies.
The valuation balance completely tilts.
Yeah.
Investors lost total faith in the very concept of profit.
They took the income statement, crumpled it up, and threw it in the trash.
Where did they look instead?
The definition of corporate success fundamentally flipped. It went from how much money did you make this year to what hard assets do you own right now?
The data on this is staggering. It shows a total paradigm shift in how capital markets operate.
Under the old rules, the coefficient for profit was a massive 10.57. Profit was king. It drove the stock price almost entirely.
Under the new rules, it flatlined.
Down to what?
It crashed down to 0.18.
Wow.
Profit became statistically irrelevant to the stock price.
Meanwhile, the coefficient for book value, net assets, the actual physical stuff you own, that jumped from 0.83 to 1.55. Investors abandoned the concept of profit entirely and clung exclusively to the balance sheet for safety.
I want to emphasize the total gravity of this shift for you. It is like hardcore sports fans completely ignoring the final score of the championship game.
Right.
They don't care who scored more points. Instead, they only bet their money on which team owns the nicer stadium and has better team buses.
It breaks the fundamental logic of the game. If you can't trust the score, you just look at the equipment.
But if profit was suddenly dead and the new numbers were just toxic noise confusing the market, did these new international rules accomplish anything good at all?
Does bad news travel faster now? Amidst all the static and chaos, the new rules did do one brutal, incredibly effective thing.
They made the blood show up faster.
The only real, undeniable benefit wasn't predicting corporate success. It was exposing corporate disaster before it could be hidden.
Look at what accountants call the asymmetric timeliness of income.
Right.
When terrible news hits the stock market, a product fails, a market crashes, how fast does it bleed into the official accounting profit?
The coefficient for the new rules was 0.25, compared to just 0.17 for the old secretive rules.
Bad news bled into the official reports significantly faster.
Why? Because there was no secret reserve mattress to hide the bodies under anymore. Under the old rules, if you lost $100 million, you just drained your secret provisions and showed a normal profit.
Under the new rules, you take the hit instantly.
Instantly.
Investors might hate the daily noise of fair value, but they absolutely love an early warning system for a fatal crash.
They want to know the second the ship hits the iceberg, not 3 months later when the captain finally admits it.
We have looked at the absolute giants of industry. We looked at BMW magically conjuring billions out of thin air.
Yeah.
But what happens when a normal, everyday company walks into this new reality?
The WashTech counterexample. Not everyone is BMW.
Did every single company get a magical multi-billion-dollar bump just by switching rules? Absolutely not.
Meet WashTech. If you do not have a massive mountain of digital ideas to capitalize on, the new rules will ruthlessly shrink you.
WashTech makes car wash equipment. They're a blue-collar nuts and bolts business.
Yeah.
They build physical machines that spray water and soap. They made the switch to the new rules alongside the giants.
Under the old rules at the end of 1999, their equity was 18.3 million euros.
Under the new rules, it dropped. It fell to 18.2 million euros.
Why? Because without massive digital R&D to capitalize into an asset, the harsh realities drag them down.
The deferred taxes, the brutal new lease rules, the pension liabilities.
All of it punished them without the upside of fair value asset inflation.
The rules inherently reward the massive tech and intellectual giants. They actively punish the traditional physical businesses.
The new economy wins, the old economy loses, just based on a rule change.
This proves a massive point about how we govern global finance. The rules themselves are not magic.
They do not operate in a vacuum.
They are completely dependent on the environment you drop them into.
The truth is finally revealed. Institutional environment beats technical standards every single time.
Europe forced this massive change because they wanted to instantly catch up to American market efficiency, right?
They want to copy the U.S. capital markets by copying their math. It totally failed.
Why did it fail?
You can copy a wealthy man's accounting math. You can use his exact spreadsheets.
Okay.
But you cannot copy his legal system. Without the foundation, the numbers are just a mirage.
The 2007 study concludes this perfectly. Just changing the technical standards on a spreadsheet does not magically boost valuation efficiency.
The real master of capital is the rule of law. It is shareholder protection. It is how courts enforce contracts.
If a country's legal foundation is different, like Germany's code law versus America's common law, the exact same accounting numbers will behave completely differently in the real world.
I love the analogy you use for this.
You can rip a 200-mile-per-hour Ferrari speedometer out of a sports car. You can duct tape it into a golf cart.
Right.
It does not mean the golf cart can suddenly do 200 miles an hour on the highway. The engine is the legal system. The speedometer is just the accounting standard.
Changing the speedometer does not upgrade the engine.
Which leads us to look at the world right now, today. We are decades removed from this pilot study, and it raises a truly profound question.
Historical cycles and unsolved mysteries. Today, over 100 countries have completely surrendered to these international rules.
The Ferrari speedometer is in almost every golf cart on Earth. But did it actually save us from disaster?
We willingly traded our safe, pessimistic harbors for a unified illusion of fair value. We burned the secret reserves.
We forced everyone to mark their assets to the market every single day.
And we might be paying the ultimate price.
The world chased absolute uniform standardization.
Yeah.
Everyone using the exact same ruler.
But the 2008 financial tsunami still happened shortly after this standard was adopted globally.
In fact, many argue fair value accelerated the crash because banks were forced to write down their assets simultaneously, triggering a death spiral.
And more crises followed. By stripping away those hidden reserves, by burning the rainy day funds, and embracing highly volatile fair value, did we actually make the global financial system more fragile?
Are we repeating the exact same history?
I mean, by making everything perfectly, instantly transparent, did we just ensure that when one single domino falls, they all fall immediately?
Because there are no buffers left to stop them.
It is a question that the massive data sets still can't definitively answer. The jury is still out on whether absolute transparency is actually safer than conservative pessimism.
I want to leave you with a chilling thought. Think back to that piece of wood and that ruler we started with.
Right.
If changing a few paragraphs in a bureaucratic accounting rulebook can literally create billions of dollars out of thin air for BMW, or instantly erase the hard-earned profits of a company like WashTech,
Yeah.
then money is not an objective reality.
It is not physics. It is not gravity.
Money is just a language.
Yeah.
And if money is just a language, you have to ask yourself a very dangerous question. Who is writing the dictionary?
Wow.
Look at your own company's balance sheet today. Look at your own personal portfolio. Which invisible rules are actually propping it all up? And what happens to your wealth the day they decide to rewrite the dictionary again?